Hello, everyone. We're Team Iris, representing the Chinese University of Hong Kong. And it's our honor today to be able to share with you our experiences in the CQA Investment Challenge 2023 to 2024. Let's start with an executive summary. We'll be splitting our presentation into 5 parts consisting of overview, onto strategy, onto portfolio, and finally performance, and then conclusion. So this is our team. We have Jackson Chan as our portfolio manager responsible for formulating our overarching investment strategy. Sunny Cheng as our short quant analyst responsible for short stock screening and risk management. Florence Chan as our long quant analyst responsible for long stock screening and compliance. And myself, Jonathan, as macro analyst responsible for market analysis, economic research, and reporting. Now let's talk about our investment philosophy. The primary objective is to maximize the return by capturing market beta through sector rotation and boosting our Sharpe ratio through alpha selection. Our guiding principle behind our strategy is to combine fundamental analysis with quantitative methods using a top-down approach. The rationale behind the idea is that market regimes are often driven by certain best or worst performing sectors, and sector momentum will sustain long enough to be captured. We also believe that shifting market regimes can be accounted for using sector rotation. In short, our investment philosophy is to long the strongest of the strong and short the weakest of the weak. I'll now pass the time on to Jackson to talk a bit more about our investment process.
So thank you, Jonathan. Following our investment philosophy, here is our investment process. First, we screen for beta and then by alpha, and finally we rank stocks quality by beta and alpha. In the indicators that we chose for beta, we choose relative strength and 2-week sector return, followed by macro indicators. The reason we choose these indicators is because we compare them to benchmark performance, we can find that the sector performance where they're performing better, and we believe this is one of the indicator that the market is signaling a market hit. For macro indicator, we are choosing interest rate and CPI since we believe that there are certain macro indicator will affect certain type of stocks. For example, if the rate is more of a linear ones, then a certain rate sensitive sector may be benefit. For example, like IT sector. And after we screen for beta, we choose alpha by the following indicator of fundamental analysis and technical analysis. Our fundamental analysis will mainly revolve around company performance, and one of the notable indicators that we use is earning beats, since we believe that if the company has beats earnings report in certain periods, there will be continuations of trends in the near terms. And for technical indicators, we mainly use simple moving average and a convergence of the short-term returns. And we believe that if those stocks that continue performing, there will be a continuations of trends due to market momentum. And finally, after we rank those stocks by beta and alpha, we rank those stocks by the quality fulfilled, and we will now discuss performance in a portfolio construction.
Thank you for Jackson for telling us about our investment process. Let me now talk about our portfolio construction. So we divide sectors into 3 groups, including the leading, average, and laggard based on beta performance. And we long more stocks in the leading sector and then less in average and the least in laggard. So you can reference the graph on the right. And our initial portfolio consists of 50 long and 50 short position. And our portfolio weighting for beta groups are 70% to 20% to 10%. And the purpose is for diversification and also to ease rebalancing. And we place equal weights for alpha to ensure compliance and also to accurately reflect each stock's contribution to the portfolio. So for trade rebalancing, we look for a sector rotation, which is the change in leader and laggard sector, and alpha change, which comes from the earnings report, and also some macro changes. And for rebalancing mechanism, we close decayed beta or alpha position and then add the new ones. And for trade executions, our stop loss is to cut position with return which is less than negative 20% or a drawdown of 20%. for stop gain, we buy and hold until the market shift rebalancing. For position sizing, we place 2% for each stock, and our rebalancing frequency is biweekly. So this graph is the timeline that's of the weighting of the stocks in each sector throughout the competition. So generally, our long dominant sectors include technology and consumer discretionaries, and the factors are groups earning beats and also favorable rate policy. For our short dominant sectors, there are energy, healthcare, industrials, and consumer staples. And the factors are decreasing inflation rates and because the fact that they're non-rate sensitive sector. So if we take a closer look to the graph, we can see that in November, we changed energy from long to short. And the reason is because of the decreasing inflation rates and also the decreasing oil price. And in November, because of the earning beats and the rates policy, we changed finance from short to long. And for finance, we capture profit triggered in January. So there was a sudden shot. And also in January, because of the significant earnings increase in healthcare, we changed healthcare from short to long. So I'll now pass the time to Sunny to talk more about our portfolio performance.
Thank you, Florence. I will be providing an overview of our portfolio's performance. We have achieved a positive return of about 14% in the past 4 months. Our strategy outperformed the average of the finalists in the CQA. It's worth mentioning that we were able to capture a significant return while our volatility is at a very low level. I will also be providing an overview of our portfolio's risk analysis and the approach we are taking to manage and mitigate risk. Our goal is to ensure stable returns while preserving capital in volatile market. The report shows that active risk is mainly composed of active factor risk, which is due to concentrated investment in specific sectors. The strategy is relying on trend and past winners. The remaining risk component, active specific risk, is low as our portfolio benefits from the diversification across specific firms. To be more specific, as we can see in the slide, market sensitivity contributed a large portion to active risk. Firstly, it's due to the core strategy, which is market tracking returns. Secondly, it is the monetary policy, specifically high interest rates. It's case selling pressure on stocks, thereby increasing risk. Medium-term momentum also needs to be mentioned as it exposed the portfolio to potential reversal in leading or lagging sectors. In addition, there is a significant active style exposure to value and dividend yield. This is mainly because value stocks have mostly performed unsatisfactorily in the last quarter and represent a low risk and safe option for short selling. And Jonathan will now sum up and provide our conclusions.
Thank you, Sunny. Overall, we think we did good in our high factor return captured related to market events and our low overall drawdown risks and good recovery ability. However, we do believe we could have done better in a better logic to determine the sector and alpha weight to capture better return and minimize risks, as opposed to currently having equal weighting of alpha and assigning sector weight by selecting alphas only. We also could have formulated a better strategy of building beta position to gradually to minimize our portfolio risks, as opposed to currently where we are rebalancing everything suddenly. Overall, we learned a lot in our CQA investment challenge, and that's it for us. Thank you.